Hi, and welcome to Weiss Ratings Behind the Screens. I'm Senior Financial Analyst Gavin Magor, and we thought we'd take a look at the business sector to show you how you can narrow down investment possibilities. So what we're going to do today is to take a look at those businesses supplying the things that we cannot be without, consumer staples. So what we're going to do first is go into our stock screener, and we'll open that up quickly, and we're going to name this staples. Having done that, we're going to add our criteria. Now, as you know, I always add the rating to start with. So we've got that there. And the first criteria we're going to look at here is going to be the sector. So scrolling down inside here, we get down to the individual sectors, and we'll select the criteria. And immediately you can see here pops up the menu. Click on Consumer Staples. These are the things that we're going to be looking at today, and when we add our next criteria, which is going to be the market capital, this allows us to choose companies that fit a size that we're interested in. Okay, we're going to add our next one, which is going to be our price to book. We want to have price to book in here because we don't want to be investing in something that has got far too much price there for the book value of the stock. We're looking for something that at least is reasonably priced. And of course, what we're interested in is dividends. So we're going to have a look down here at the dividend, add the dividend yield, and immediately we're going to also add the payout ratio. Now, the payout ratio is of the profits that have been made, how much of this is actually being reinvested in the company versus how much is being paid out in a dividend yield. We're going to add the trailing 12-month number, and we're also going to look at the returns because we're very interested in how the returns are. We're looking at not only the 3-month period, which is what we're going to be putting in here, but also we're going to be looking at a 1 year and a 3-year period. So we'll add the 3 months there to show how we're doing now. We're going to have a look here at the period for a little bit further away, which was the 1 year period. And we're going to, that's the 1 month. Let's go back in there. It's real easy to correct. So we just put in 1 year. And then we're going to add in the 3-year period. So then we'll be able to look at those numbers and we'll be able to make some decisions based on these total returns. And let's have a look down here at the 3-year period and add that criteria. Okay, so now we've got our criteria, we can just do a little bit of a look at what we've got. We've scrolled down here and you can see we've got 374 companies. So as you can see, we've got some that are in the D range, and clearly, we're unlikely to be recommending those because we don't consider those to be a buy or even a hold. They're a sell. But what we haven't done yet is to look at these narrowing down in the individual criteria. So we're going to look at the market capital. We're looking for companies that you can put your money in, and the company is likely to be around for a while. So let's look at some substantial size of, let's say, $25 billion. And instead of a 50,000 price to book, which sounds extraordinarily large, we're going to put something in the region of, let's say, 8. Okay, so nothing that has got a price of more than 8 times the book value is going to come up in our selection. Our dividend yield, well, let's look at something in the region of 2.5% and a payout ratio of about 50%. Okay, so we don't want them to be putting out more than 50% of the profits in dividends. We want them to be reinvesting in the company. So let's have a look down here and see how many companies we've got. Well, as you can see, that's narrowed down a lot from the 300 and odd that we started with. We're down to 4 companies, 2 of which are in the B range, which is a buy, and 2 of which are in the C range, so those are in the hold area. So let's have a look across here and see what else we can see from these numbers. Now, if you look at the 3-year return, the sorting that gives you the largest one was 139% over 3 years. Then you got 28%, 20%, and 7%. So without looking at the individual companies, let's look at the 1-year return. And you can see here that in this particular one on line 2, There was a loss, in fact, over the 1 year period. So this one has gained a lot in the short term, lost last year, but overall in 3 years has made certainly a decent return. And then here again, you've got on the third line one that was profitable, has been profitable throughout. And this last one here has also gone sort of a bit up and down. They actually must have had a big drop after the 1 year and has then gone up again. So let's have a look at those companies. Let's see what they were showing. And in fact, as you can see, the Walmart and Archer Daniels, those were the ones that weren't entirely recommended. And those are the ones with the slightly variable types of returns. Whereas Reynolds American and Procter & Gamble came up as well-performing and well-rated. So you can choose whether you're going to invest in these particular companies. You may not want to invest in the tobacco business, and you can make those decisions yourself. So I've now shown you how you can set up your screener to look into a particular sector. So go ahead, take a look on the Weiss Ratings website, create your own. Remember that you're in control and you can decide to add, delete, or amend any of the criteria that I used today. Thanks for joining me, Gavin Magor, Senior Financial Analyst at Weiss Ratings, empowering you with investment confidence. Until next time, cheers.